Hello everyone. This short presentation introduces the topics of risk transfer and parametric insurance. It is based on a presentation given during the MedEWSa General Assembly in September 2025. Risk transfer is a strategy by which an organization or an individual shifts the financial consequences of certain risks to another party. In simple terms, this means insurance. Most of us have some form of insurance, and in some countries, like Germany, people tend to insure almost everything. For example, you may own a car and insure it against damage. That is the traditional way to transfer risk. In this approach, you pay a premium to an insurer. In return, if damage occurs, you receive a payout. This means you no longer carry the financial risk yourself. Instead, the insurer carries the risk in exchange for the premium. There is also the concept of alternative risk transfer. This refers to non-traditional ways of transferring risk. Most insurance products you personally have are traditional so-called indemnity-based insurance. Alternative simply means that something is done differently. One important example is parametric insurance. This is particularly relevant for MedEWSa. In this case, the payout is not triggered by actual damage. For example, with car insurance, you typically have an accident, report the damage, submit a claim, wait for processing, and then receive compensation. In parametric insurance, which is common for natural hazards, the payout is based on parameters exceeding a predefined threshold. For instance, if you have insurance against windstorms, your policy may state that if wind velocity at a specific location exceeds 50 meters per second, you receive a payout. No one checks whether your roof is damaged. You simply receive the money immediately. This approach has several advantages. It is transparent, fast, and unbiased. There is no need for inspections and payouts are automatic. However, the parameters must correlate with actual losses. Otherwise, the approach would not be meaningful. Typically, thresholds correspond to return periods of 20 years or more. A 20-year return period means a 1 in 20-year event. The higher the return period, the rarer and usually more damaging the event. Now let us move on to catastrophe bonds. These transfer risk to capital markets instead of traditional insurers. They are always parametrically structured, meaning that payouts depend on predefined parameters. The beneficiary is usually a government or a large organization. On the other side are investors, for example pension funds who buy shares in the bond. The bond typically lasts between 1 and 3 years. If no triggering event occurs, investors receive their initial investment back, along with the premiums. If the event does occur, the beneficiary receives the payout, and the investors lose their investment. This creates benefits for both sides. Beneficiaries gain financial protection, and investors gain diversification opportunities. To build such structures, several components are required. These are often referred to as agents. First, the modeling agent. This involves calculating probabilities, such as how likely events are and what potential losses may occur. This step is essential for actuaries and financial experts to design a viable policy. It includes running catastrophe models to estimate the probability of losses. Next, the structuring agent here. The financial structure is defined. This includes how parameter values translate into payout amounts. All payout rules are predefined in the policy. Finally, the calculation agent. This entity monitors events and determines when thresholds are exceeded. It performs the necessary calculations and confirms whether payouts should be triggered. This is where many MedEWSa partners are involved. Together, we are building a platform to support this system. We have now introduced the key concepts of risk transfer and parametric insurance. We hope these ideas are now clearer. Thank you for your attention.